Hi and welcome to Lever Brothers tutorial on bullish rectangles. Bullish rectangles represent large periods of doubt and indecision. They're characterized by parallel trend lines as the forces of supply and demand are nearly equal. The pattern is typically large and forms either horizontally or with a slight downward slant against the overall uptrend and typically resolves in the direction of the trend. Breakouts to the upside must be accompanied by a significant increase in volume to confirm the move. Failure to accomplish this doesn't automatically render the play invalid, but it does raise a yellow flag. Besides volume, if the pattern slants against the trend, a close above the most recent high is needed to confirm the breakout. This price represents the previous area of selling pressure in an area where stockholders may be looking to get out even. It is recommended that if volume does not accompany a breakout, and if the stock fails to make a higher high within a reasonable amount of time, the trader should move a sell stop up to protect profits. There are a couple methods used to determine the expected price movement. 1. The movement is likely to equal the height of the rectangle. And 2. Price movement is likely to equal the move into the pattern. Some traders will measure to the far side of the pattern as shown here and then project it up from the breakout area, while other traders will use the midpoint of the pattern as shown here. There is no right or wrong answer. This isn't an exact science. Targets are meant to give you a frame of reference to work from. They are not set in stone. The extent of the advance will often depend on the overall market. A strong market will help greatly in achieving a more ambitious price target, but in a weak market, a trader should be happy with a moderate advance. As a side note, rectangles are difficult to play. Symmetrical triangles have converging trend lines and therefore must break out by a certain day. But since rectangles have parallel trend lines, and therefore theoretically can go on for many months, no time horizon is offered as to when a stock will most likely break out. Let's look at a couple of examples to highlight these concepts. Here's Hess Corp. A solid rally led to a bullish rectangle pattern which slants against the overall trend. Volume was solid on the breakout, and the previous couple highs from within the pattern were easily taken out. And in this case, the move to the midpoint of the pattern did a good job identifying the first area the stock would run out of directional energy. Here's Motorola. A 50% rally led to a 3-month bullish rectangle. Volume was solid as the stock broke out and it continued for the following couple of weeks. The move out of the pattern matched the move into the pattern when using the midpoint as a reference level. Let's quickly go through a few more. We find it helpful to look at successful pattern formations to train our eyes. Delphi Automotive. Inside the pattern there were big days and small days and gaps, so the action wasn't smooth, but the parallel trend lines did a good job containing the movement. Volume surged on the breakout, exactly what you want to see. Superior Industries. Nice rectangle within an uptrend. Volume surged on the breakout and stayed strong for a couple additional weeks. Amazon.com. This pattern was so big we show it here on the monthly chart. It took 3 years to form, and when it busted out, the stock more than doubled in just a couple months. That wraps up this tutorial. Again, bullish rectangles are pauses within uptrends and should see a significant increase in volume upon breaking out. The extent of the advance will often depend on the overall market. A strong market will help greatly in achieving a more ambitious price target, but in a weak market, a trader should be happy with a moderate gain.